Stop moving your stop belief conflicts. That Nuke risk reward in day trading always right, but you still build small temples to your opinions. That's normal. The brain is a pattern-making machine that hates uncertainty. Under stress, your mind chooses emotional certainty over probabilistic truth. Mark Douglas taught that our beliefs built for structured cause and effect environments don't translate to the unstructured auction of markets. So when your position ticks against you, your socialized belief that effort produces result clashes with the market's indifference. That's the conflict that makes your finger slide your stop, a desperate attempt to restore internal harmony. Brett Steenbarger talks about performance pressure, how focusing on outcome, don't stop out, don't lose, hijacks attention from process. Observe order flow, honor the plan. Add modern behavioral finance from trading psychology, Type 2.0. Loss aversion punishes you twice as much for a loss as it rewards you for a gain, so your brain inflates the meaning of a small red number until it feels like identity-level danger. Meanwhile, your dopamine system remembers the last time you gave it room and got away with it. That variable reward schedules your habit like a slot machine. You don't move your stop because it's rational. You move it because your nervous system wants the relief of avoiding pain right now. Here's the trading paradox that twists the knife. The best trades rarely need room because you sized right, placed the stop where the setup breaks, and accepted the loss up front. But the ones you love most, the perfect confluence trades, are the very ones that tempt you to protect your belief instead of your account. You overanalyze, widen stops, add size, and turn a defined risk idea into a negotiation. More analysis equals worse results. Tighter intraday focus equals bigger drawdowns. And the more you watch level 2, and every micro tick, the less you see the structure on higher time frames. The market doesn't punish opinions, it punishes inflexibility. Douglas calls this mental house cleaning. You clear beliefs that demand certainty and replace them with ones that accept risk as the ticket to play. If you won't do that, your body will try to do risk management for you by moving the stop to wherever your fear stops screaming. Let's look at the costly pattern as it actually unfolds on your platform. You take a long at the break of intraday resistance with a stop below the last higher low. Your plan is 1R risk for 2R reward at the prior day's high. As price pulls back, you stare at the unrealized drawdown and convince yourself the real level is 5 cents lower. You move the stop. Price test there, you flinch, you move it again, telling yourself liquidity is obviously pooling at the pre-market pivot. Your risk goes from 1R to 1.5R without any improvement in odds. That stretches your required reward target out of the market's typical range for this time frame. But you don't notice because you're busy arguing with a candlestick. The pullback extends, your P&L flashes uglier, and now any relief becomes the goal. You scratch the trade or capitulate at the low. Minutes later, price reclaims VWAP and runs to your original target without you. You log the day as market manipulated me, but the tape shows the truth. You removed your ability to be paid when you abandoned the risk boundary that defines your setup. You didn't get stopped out by randomness. You got stopped out by belief conflict. Now meet Marcus, the risk manager. 2 monitors show price action and the higher time frame. A third holds his journal and statistics. He trades the futures open with pre-marked levels, ATR-based stops and fixed R entries. The first thing he does each morning is write his contract. If a setup triggers on the 1 minute with alignment on the 15 minute, risk is N.5R per contract. Stop at structural invalidation. Target at 2R unless order flow degrades. He says it out loud like an oath. His routine is mechanical, the way to trade in action, so he doesn't burn decision-making fuel on basics. When the market opens, adrenaline pops, but Marcus breathes on a 4-count cadence. He watches the opening drive, marks the first pullback, sees buyers defend at a prior micro swing. Entry triggers. His stop is not room. It's a line that if touched means the reason for the trade is gone. He doesn't move it because moving it would redefine the entire trade into something untested. He knows the Douglas rule. Risk defines the trade. He also knows Steenbarger's warning about performance tilt. So when a wick tags near his stop, he scans volume and order flow instead of his P&L. If the tape contradicts his thesis, he's out. If it doesn't, he holds through discomfort with a calm, practiced focus. He's been here before, literally. He rehearses in replay mode nightly. Marcus blew up a small account years ago by widening stops on a can't-miss setup. He has that account statement taped to his wall, not out of shame, but as a risk talisman. He's read Market Wizards enough times to treat disciplined stories like case studies. The pros aren't brave, they're consistent. His belief system says the purpose of a stop is to end a trade whose premise is gone. The feeling of pain when a stop hits is not a verdict on him. It's the price of staying in the game when the odds return. He holds fewer beliefs, but they're stronger and behaviour linked. He doesn't tell himself stories about market makers hunting him. He tells himself a simple cue: trigger, stop, target, review. The screen doesn't get a vote in his self-worth. He sizes his position so the cortisol spike from a stop-out doesn't scramble his frontal cortex. He never risks more because a setup looks perfect. In fact, when it looks perfect and feels comfortable, he warns himself that comfort can be a trap. The best trades often feel uncomfortable because you're long into fear or short into euphoria. He learned that paradox, and now discomfort is just another data point, not a command. So how do you rewire your trading so belief conflicts stop pushing your stop? First, codify your stop architecture. Define the invalidation point structurally below dark above the swing that anchors your setup, or at a level that breaks market structure, not emotionally. Use ATR or recent volatility to anchor distance so you're not placing stops where noise lives. Then back into position size so 1R equals a fixed fraction of your daily risk budget. Risk defines the trade. Size translates that risk into contracts or shares. Write it down before the open. Second, make your stop a contract, not a suggestion. Literally read it aloud before you click. If price prints below X, the long is invalid and I'm flat. That verbal commitment recruits your prefrontal cortex, giving it a script when limbic panic surges. Third, run discomfort drills. In replay or sim, practice holding the last third of a position to target while price wobbles near your stop. Count breaths, narrate order flow aloud, and keep your mouse away from the stop button unless invalidation actually prints. You're training your nervous system to separate sensation from instruction. Fourth, adopt a two-gate rule. Gate 1. A setup exists. Time frame alignment, support, chocolate resistance, order flow cues. Gate 2. Your state is tradable. No revenge urge, no tilt after last stop, no FOMO. If either gate fails, you may not trade. This prevents moving a stop because you never entered with a fragile mind. Fifth, audit the numbers, not the story. Track every trade by whether you respected entry, stop, and target. Grade yourself only on execution quality, not outcome. You can't control the market's randomness. You can control whether you followed your tested edge. Sixth, pre-commit to a daily risk circuit breaker. If you hit 2R or your personal threshold, the platform logs you off, or you put a lock timer on orders. This diffuses the revenge trading loop that often begins with a widened stop. Seventh, use alerts as distance, not as decisions. Put an alert above your stop to warn you as price approaches so you can scan order flow with curiosity, not with a hand hovering over modify. If the level prints, you're out no second vote. Eighth, adopt a cooling off protocol. After any stop out, you must wait 1 5-minute bar or until the next A setup. During the wait, you write one sentence. The stop protected my risk reward. My job is to be available for the next edge. Ninth, probability inoculation. Before the session, write 3 scenarios that will stop you out and imagine yourself accepting them calmly. Mark Douglas called this mental house cleaning. You accept fully that any single trade can lose, even a great one. Acceptance shrinks the belief conflict because you aren't trying to force certainty onto an uncertain process. 10th, widen perspective to shrink fear. Keep the 15-minute or hourly chart visible, even if you enter on the 1 minute. The higher time frame context prevents chart pattern hallucination, where you see meaning in every micro tick and treat random wicks as destiny. 11th, build a stop wall. At the start of each week, you screenshot 3 trades where honouring your stop saved you money and print them. Your brain needs visual evidence that following the rule has paid you. The dopamine system is trained by wins. Give it wins for discipline, not just P&L. 12th, finish with a micro journal. 3 lines, state, setup, stop. If you moved a stop, write exactly why and what the structural signal would have been to justify it. Most of the time you'll discover there wasn't one, and that honesty is the beginning of change. Picture the transformation. You sit at the open and the tape is loud, but your breathing's quiet. You identify your setup, place the stop where the idea fails, and size so the risk fits inside a calm body. A red wick drills toward your line. You don't negotiate because negotiation is not in your plan. Either your premise holds or it doesn't. You feel adrenaline normal. You scan volume, delta, and the prior swing. If the invalidation hits, you're flat without drama. The loss lands. But your identity doesn't wobble because you pre-accepted it. You move to the next candle with the same energy you had before the last one. When winners run, you don't choke them with lock-in trailing stops that get whipsawed on noise. You scale with intent at 1R and 2R, or trail at structure, not last price. Your day ends green or red, but your log shows the same conduct. Stops honoured, risk unchanged, trades taken in alignment with your plan. Over weeks, your R distribution smooths. Drawdowns shrink because you aren't converting 1R ideas into 3R disasters. Win rate may not surge, but expectancy does because your average win isn't capped by fear, and your average loss is capped by your line. Marcus would tell you, 1 breath per trade. Each position is a bounded bet in a probabilistic game, not a referendum on your worth. The stop is not an insult from the market, it's the seatbelt that lets you drive at speed. Revenge trades, overtrading, moving stops, these are the brain's clumsy attempts to escape discomfort. But you don't need escape. You need rules rehearsed and respected that harness discomfort into clarity. Accept that some of your best trades will feel wrong at entry, that perfect conditions often fail, that more screens can mean less insight. Accept that sometimes, after immaculate process, you'll take 3 stops in a row. Most traders lose money. Most traders also move their stops. If you aim to be in the smaller group, adopt the belief system that frees your risk-reward instead of nuking it. Risk defines the trade, the stop defines the risk, and your job is to honour both so your edge can do its quiet statistical work. Not financial advice, just the operating system of day traders who stopped arguing with candlesticks and started trading their plan.